Welcome, everyone. I am absolutely thrilled to guide you through this explainer today, because we are unpacking a massive, fascinating divergence. We're looking at Datadog, a company sitting right at the absolute epicenter of the enterprise AI boom, experiencing exploding growth. But when you look at their underlying valuation metrics, well, it might just make you sweat. If you're someone who loves rapid, cutting-edge tech innovation, but also respects the cold, hard reality of forensic accounting, you are going to find this deep dive incredibly interesting.
Here is our game plan for today. We'll start with their recent billion-dollar milestone, then dig into the AI growth engine. After that, we'll compare cash flow to GAAP profit, look at that sky-high valuation, touch on the competition and macro risks, and finally, give you the ultimate verdict. Let's get right into it.
Section 1. The billion-dollar milestone.
Okay, we have to start with the sheer scale of momentum Datadog is experiencing right now. This number is just huge. They recently crossed a major threshold, bringing in over $1 billion in a single quarter for Q1 2026. Hitting $1.006 billion in revenue isn't just a psychological win, right? It totally validates their position as an indispensable layer in the modern tech stack. They aren't just some niche observability tool anymore. They're literally becoming a core utility for the cloud.
And this perfectly captures the hype. We're talking 32% top-line growth year over year, and management actually raised their forward guidance for the full year up to over $4.3 billion. That tells us they have massive visibility into their future sales. A lot of that visibility comes from their remaining performance obligations, or RPO, which surged an astonishing 51% year over year to $3.48 billion. Think of RPO as contracted revenue that hasn't been recognized yet. It's essentially a massive backlog of locked-in cash. The market obviously loved this level of certainty, sending the stock surging 31% right after the earnings print.
Moving on to Section 2, let's talk about the AI growth engine. You know, Datadog isn't just resting on its laurels here. They've launched an absolute flurry of AI products. Take their new Bits AI security agent, for example. It's designed to autonomously analyze alerts, which could potentially slash threat investigation time by up to 98%. That's wild! Then there's GPU monitoring, helping companies optimize their incredibly expensive AI infrastructure spend. They are really expanding out of traditional cloud observability and getting deep into actual AI workload management. They even announced the strategic partnership with Sakana AI to drive enterprise adoption over in Japan.
So the takeaway here is that enterprise adoption is accelerating, and fast. To put this into perspective, look at their highest-paying customer cohort. Customers spending over $100,000 in annual recurring revenue grew by 21% year over year, jumping from 3,770 up to 4,550. These massive enterprises are increasingly leaning on Datadog to keep their incredibly complex, mission-critical AI systems from completely melting down.
An analyst at Benchmark hit the nail on the head with this. They pointed out that this isn't just marketing fluff. It's a genuine product shift that's driving intense cross-selling. Right now, the average Datadog customer actually uses almost 7 different products from their suite. Just 2 years ago, that number was 4.5. They are successfully becoming the digital glue holding enterprise systems together. And once you're the glue, it is incredibly hard for customers to ever leave.
Let's pivot to Section 3, cash flow versus GAAP profit. Time to look under the hood.
What's really fascinating here is the massive divergence between their reported profitability metrics. On the one hand, they reported a GAAP operating income of just $7 million. That is a microscopic 1% margin. But if you look at it on an adjusted, non-GAAP basis, operating income suddenly leaps to $223 million, a highly attractive 22% margin. You gotta wonder, right? What exactly is driving a $216 million difference in a single quarter?
Well, the main culprit is heavy stock-based compensation, or SBC. Datadog paid out nearly $197 million in SBC in this quarter alone. Now, it's a non-cash expense, and yet it's super common in tech to attract elite engineering talent. But quantitative analysts view this as a very real, significant drag on long-term shareholder value. By constantly issuing new shares, they are diluting the ownership stake of existing shareholders. It's kind of like a hidden tax that makes achieving true profitability a whole lot harder.
This brings us directly to Section 4, the sky-high valuation.
Okay, brace yourselves for this one. Datadog has a staggering trailing PE ratio of nearly 690 times. When you compare that against tech titans like Microsoft, Amazon, or Google, you immediately see the insane premium investors are paying for that 32% growth rate. Even looking forward, it's trading at over 93 times forward earnings, all for a net margin of just 3.7%. Just compare that to Microsoft, which is handing you a nearly 40% net margin at a tiny fraction of that multiple. Because of this extreme valuation, AL Capital Advisory actually slapped an avoid rating on the stock. Their discounted cash flow scenarios really spell out the risk here. With the stock trading around $269, even their optimistic bull case only targets $375. But look closely at their base case. Even assuming a very generous 28% compounded annual revenue growth, it suggests the fair value is only $265. That implies a negative 30% margin of safety. And if things go south with their bear case, it drags all the way down to $145. Basically, every ounce of good news is already totally baked into the current price.
So the quants are warning us. Trading roughly 75% above its own 5-year median means this stock is priced for absolute, flawless perfection. And when a stock is priced like that, it creates massive asymmetric downside risk. Meaning, if they execute perfectly, great, the stock might just hold its current value. But if they miss earnings by even a fraction, or if growth slows down just a tiny bit, the market's penalty could be brutal.
Section 5. Let's look at competition and macro risks.
Valuation isn't the only thing to worry about. Datadog operates in a fiercely contested space. They are facing immense pressure from native cloud hyperscalers. Think AWS CloudWatch or Microsoft Azure Monitor. The real danger here is that these native tools are constantly getting better, and they are often bundled at literally zero marginal cost to the cloud customer. It makes them the path of least resistance. Plus, Datadog is still fighting off established legacy players like IBM and slugging it out with specialized peers like Cisco, New Relic, and Dynatrace for every single contract.
On top of that, management openly noted in their filings that their largest enterprise and AI-native customers might start trying to optimize their usage. In plain English, that means cutting cloud spend or slashing IT budgets if the global economy taps the brakes. Couple that with the skyrocketing costs of running their own AI infrastructure, since Datadog needs serious GPU power for its own analytics, and you've got a very real threat to their future profit margins.
Finally, Section 6. Let's get to the final verdict. So how do we weigh all this? We've got two very distinct realities here. In the bull corner, you have a company executing flawlessly on innovation and sales. They are riding an undeniable AI supercycle and proving they are an absolute must-have for the modern enterprise. But over in the bear corner, the financial models are screaming that all the future upside is already priced in. It's weighed down by heavy stock-based compensation, and it's trading at a massive, nearly 700 times PE multiple that leaves absolutely zero room for error. Which leaves us with this final, burning question to take away. In the incredibly fast-paced, shifting landscape of enterprise tech, is Datadog's AI moat truly deep enough to support a 700 times premium for years to come, or is a painful correction just inevitable the very second their hypergrowth stumbles? It is a high-stakes puzzle for sure, and the next few quarters are going to be absolutely critical to watch. Thank you so much for joining me for this explainer, and remember, keep questioning the data.